Well, we've got some bad news for Meta and a lot of employees at Meta as well. But in this video, of course, we're going to focus on the stock, which is down 7.92% today. And the whole market's down today. It's not just them. So there is that. But if you want to compare how much worse Meta's doing today versus the S&P 500, which obviously a tech stock's usually going to go much lower or much higher on a given day than the S&P 500, which is more conservative and diversified. But the whole market, or at least the S&P 500, is down 1.77%. And then if you compare it to Meta, of course, now they're at almost 8% down today. Part of this is some news that, things have not been going too well at Meta. And they failed with the whole VR thing. They actually had to shut down VR. They're making massive job cuts across Reality Labs, Facebook, and other areas. It looks like about 700 employees, according to the New York Times. And if you want to summarize this, they're looking at somewhere between 700 and 1,000 workers getting laid off. A lot of this has to do with the virtual or augmented reality division, which I think they called the metaverse and everything, where they thought, oh, everybody's going to wear these big clunky headsets and basically have like a Ready Player One type of life. Well, apparently that's not going to happen right now. It just never got enough traction. And so they're focusing more on AI and Facebook and Instagram and what they know or think will work. They are now going to spend $115 to $135 billion in AI infrastructure. And Mark Zuckerberg is pretty much going all in on AI now. Of course, another problem with this is they are actually rewarding top executives after laying off hundreds of people that work there, giving incentives to executive workers that equal a total of nearly $1 billion. So obviously that's a PR nightmare for them, but they should have known that before they did it. Now, over the last 5 years, Meta stock has actually been pretty strong, but of course, 2026 has not gone off to a great start for many companies, including them. They also had a massive drop back in April 4th, 2025, but then they went and hit, I believe, a all-time high back around August of last year. So if you look at how they've been doing over the past 5 years, they're still, if you compare it to the S&P 500, they are still outperforming the S&P. They are down 10.35% over the past year, which is not good, of course, but that's just one indicator. But if you look at the past 3 months, it's not looking good either. 3 months is something I like to look at because, of course, that would be the equivalent of a quarter. And that is down 17.7% in the past 3 months. Now, if you look at their most recent quarterly financials, they are up 23.78% year over year. That is Q4 2025. And then you have earnings of EPS beat of 8.6% and revenue beat 2.43%. So no real big red flags there, but net profit margin did go down 11.75% year over year in Q4 2025. They don't offer much of a dividend at 0.38%, so you are really relying on this for growth, especially long term. Now, over the course of their time as a publicly traded stock, they started around 38. Now they are at 547. So all time, they've been a major riser, one of the top tech stocks out there over the past few decades. But the question is, will that continue? Is this possibly like a buy low? Is this something we should hold through? Is this bad enough to where it would make a lot of our returns go into the red? There's a lot of question marks here. Their PE ratio is actually not that bad, especially compared to a lot of tech stocks. It's actually quite low. 18.93 is very good. A lot of investors like to get around 20 or less, and they are in a reasonable territory there. If you look at their balance sheet, they are doing okay as far as assets versus liabilities at over a 2-to-1 ratio there. If you look at their return on assets and their return on capital, it's actually quite strong at 18.47% and 22.6% respectively. Usually you want something like around 8 to 10% at least in those categories. Now, if you look at the PE ratio on Robinhood, it's a little bit higher at 25.33, but nothing too crazy as far as the difference between what you see on Google Finance and here. Again, it is 7 points or so higher, but usually Robinhood uses like a trailing PE ratio and Google uses like a forward PE ratio. Now you can look at what like regular users are doing on the Robinhood platform, and you can see a lot of people have been buying lately. Obviously, that doesn't mean much, but it's interesting to look at. Hedge funds, of course, their entire existence is based on trying to beat the market and to get the best returns for the elite. And if you look at what they're doing, pretty even. Q4 2025, of course, that's not going to be the most recent quarter. I expect that to be quite different this next quarter. But if you look at Q4 2025, pretty even split, 51% buy, 49% sell. Insiders, I mean, I would take that with a grain of salt just because a lot of insiders just sell off just to take a little profit here and there. As far as analyst scores, they do still have Meta at a 90% buy score, which is quite high. I don't know how often they actually update these. Obviously, the recent news could change some of this, but you do have a pretty good sample size of analysts at 73 ratings. 9.6% still give them a hold score. Now, they did lower guidance between Q4 and Q1, so that might have been part of the reason their stock has been going down, maybe a bit of a sell-off on top of the market just being kind of unhinged in general right now as well. But typically they do beat on estimates. Every single time over the past couple of years, they have actually beat on estimates, as you can see by this chart. Now, if you look at their forward PEG ratio, this is the forecast 12-month forward PEG ratio, which accounts for growth as well instead of just a regular PE ratio, which is price versus earnings. So this accounts for growth as well, and this has a 0.92, which is actually quite reasonable. Usually you want something like 2 or less, maybe even 1 or less, and this one is in more of a reasonable area where some might even call it a bargain, but I don't really like to call it that just from one indicator. Now, as far as their EV to EBITDA ratio, this is another thing that is kind of an alternative to a PE. Theirs is a 4.26, which is actually worse than 70.16% of 372 companies in the interactive media industry. Of course, that's not all they do, but that's where they are classified right now. But I like to look at the number itself more than necessarily how it's ranked versus companies, because a lot of times I think these are not necessarily in the right category, or some companies you can't just put in a box like that because they have many different ventures like Meta does. But a 14.26 seems pretty reasonable. You can see that's in the green as well. And it's kind of more like a raw version of a PE ratio that doesn't take into account like accounting and things like that. If you want to judge leadership, which I like to at least try and see what the company culture is like somewhere before investing in them, Meta has a decent score, 3.7 out of 5 from Glassdoor ratings. 61% recommend working here to a friend. So above average or above 50% on both of those scores. Mark Zuckerberg as a CEO, barely above 52% or barely above 50% in general at 52%. Could be better, of course. Work-life balance could be a little bit better. But as far as would these numbers be a huge red flag? I wouldn't say they are. Now, to sum everything up, one thing that's interesting is killing the metaverse and the augmented reality and all that stuff. That might actually be a strong sign going forward that they are willing to stop throwing money away into something that's just not working. And a lot of times when a company cancels something that they're spending a lot of money on, it ends up benefiting their stock and their outlook long term. But that's just one thing. Now, one scary sign is how much they're going to spend on AI infrastructure this year. And it feels like a huge risk, even though the AI race is a huge deal and a lot of companies are taking part in it. It's not clear whether they're one of the front runners and whether or not this is going to actually lead to more profit. So they're basically trading billions of dollars into augmented reality in the metaverse for billions of dollars into AI. And we're not sure how that's going to go. Now, if you combine that with layoffs, that could mean they're uncertain this is going to pay off soon when they spend hundreds of billions on AI. So that also might be leading to such a major sell-off today. So their core business should be fine. They're still one of the best ad platforms on the entire internet because of Facebook and Instagram. It's not necessarily that they're giving up on the metaverse stuff that's concerning. That's not necessarily a bad thing. I mean, maybe that was just too early. Maybe it's one of those things, kind of like the Google Glass thing a long time ago, where they were just too early and it wasn't ready to catch on. The biggest question and the sell case here would be like, well, they're going to spend hundreds of billions of dollars on AI, but they may not even be able to reap the rewards of that anytime soon. So you kind of have that like somewhat safe baseline with their ad revenue and with social media, but you have this huge expensive risk that you don't know if it's going to lead to profits or not. So the bull case would be like, well, they have some of the best ad revenue in the world, and this spending in AI is going to pay off. The sell case would, of course, be we have no idea if all of this spending is going to lead to more profits or if this is going to end up like the metaverse thing. The hold case, if you already have it, is you're basically just betting on Mark Zuckerberg figuring it out with AI. It's kind of a high risk, high reward right now. And you also have to ask yourself, are there other similar stocks that have a better outlook? For instance, if you are betting on AI, which a lot of investors are, you have to ask yourself, is Meta one of the best horses to have in that race? Even though it's low right now, I would be scared to buy more Meta right now, but that's just me, of course. None of this is financial advice. Make sure you do your own research, and everybody's portfolio is totally different. Everybody's goals are different. But hopefully this was helpful, and I'll see you in the next one.